like the vast majority of our guests are now arriving, and this is probably a good opportunity to get started. So firstly, hello and a very warm welcome, and thank you for joining our webinar event today. I'm Neil McKenzie, Senior Sales Director here at BMLL, and I will be moderating today's session for you. This is the first in a brand new series that will be running throughout the course of this year. Our Chief Product Officer, Dr. Elliot Banks, is going to be exploring the market microstructure of both European and US equities and ETFs. He's going to be using our level 3 data and analytics to highlight differences in market quality and liquidity. And he's going to be highlighting how differences in regulation, fragmentation, and market microstructure can impact execution analysis and best execution. Just a few very quick housekeeping points before we get started. This webinar is going to last around about 30 minutes, and we're going to leave 10 minutes at the end for any questions that you may have. If you do have any questions, we encourage you to use the Q&A button at the bottom of your screen. I'm sure you're more than familiar with Zoom by now, but please do pose any questions that you have throughout the webinar today. Your questions will remain anonymous, and we'll do our best to answer as many of these at the end of the presentation. This webinar is being recorded, and we'll make the link available to all our guests once we've finished. So without further ado, let's get started. I'm delighted to introduce you all to Dr. Elliot Banks. Hello, Elliot. A very good afternoon, good morning to you.
Hey Neil, how are you doing? And good morning, good afternoon to everyone on the webinar today.
So Elliot, perhaps for the benefit of our audience, and especially for those joining us for the first time, I wonder if you could provide everyone with a little background on BMLL to help them understand what we do, how we do it, and why we do it.
Sure, no, and welcome back to those who came to some of our webinars last year, and welcome to those who are new to them. So a little bit about BMLL. So BMLL, we're a historical data and analytics company. We take the most granular data sets that we can get from a variety of different venues across European, US equities, as well as global futures. We take that data and we make it consistent over time and across venues. And we then put that data, that level 3 data, into a series of different products that customers can use. And that's our data lab, which is a scalable Python environment that allows you to quickly go in, query our level 3 data and trades data, run analytics, and really get your results very quickly. We've then got our data feed, where we've internalized that lab ourselves to provide pre-canned analytics and make it quick and easy to get the answers and insights from the data without having to munge it yourselves. And finally, we've got our data viz suite of products, which are UIs, GUIs that allow you to quickly and easily interact with the data, analyze it for whatever workflow and whatever need you have.
Great, thanks, Elliot. So as many of our audience will know, we ran several webinars last year which were focused solely on the trends and stories related to European microstructure. And following some of the super feedback that we had from those events, we've decided to look at the equities and ETF trading landscape in both Europe as well as the US now. So perhaps a nice place to start is to talk through some of the fundamental differences, both in terms of liquidity and also the trading mechanisms that exist in each region.
Yeah, no, Neil, that's a really good question. So we actually pulled out a few little high-level statistics to look. We looked over 2021 at some specific indices and just looked at, okay, what's some of the key stats and some of the key differences and similarities that we have between the US and Europe. Now, the first thing that really jumps out is just how much bigger the US is than Europe. It's probably not a surprise, but actually, we were looking at this year. I think that the three most liquid securities in the US have actually traded more than the FTSE 100 has traded. Just to give you a sense of scale and what's going on. But there's a few more really sort of powerful and interesting things that we pulled out using the data lab to look at this. And one is, which would maybe start with Europe, is, Europe isn't one regime. There's a whole myriad of regimes. We might explore that from a regulatory perspective later on. But the proportion of lit trading versus other mechanisms does change across different European markets. And we've obviously had Brexit last year, which has diversified and changed some of the direction of regulation in Swiss and UK equities versus other European equities. But if you actually look at the percentage of trades that are lit on, say, the UK versus Italy, it's hugely different. I mean, got less than a third of the UK 100 was trading, on the lit versus trading through the dark and through other mechanisms, versus Italy, which is much more highly concentrated in terms of lit trading. So you've got these differences and nuances between the different markets. In contrast to that, the US actually does have quite a high level of lit trading versus other mechanisms, and we might explore that later in the webinar in terms of some of the mechanisms that we see in Europe that we perhaps don't yet see in the US, but are starting to come out as well. So really, in summary, the US clearly trades a lot more, but actually there's lots of nuances in the European market in terms of how different venues are trading on lit versus dark versus what we see in the US.
Yeah, Elliot, you mentioned Brexit and the obvious impact that we've seen in terms of fragmentation of liquidity in Europe, at least. And I'm wondering if we now delve a little bit deeper into the regulatory aspect and impact that we've seen on both liquidity and fragmentation, both in Europe as well as the US. So in Europe, for example, we're very familiar with the 2 iterations of MiFID, and the US led the way with the introduction of Reg NMS. Both of which have led to a proliferation of new trading venues and new mechanisms which have created a very competitive but also a very fragmented equities and ETF trading landscape. So I'm wondering, would you be able to analyze and show how this has played out in each region and what the differences are in terms of regulation and the impact this has had on order book liquidity and market quality?
Sure, that's a really good point, Neil. That, and I think what I'll do is I'll start with Europe and then maybe talk about the US secondly. So in Europe, we touched briefly on Brexit. Obviously, that happened at the start of last year, and what that means now is we have a different regulatory regime in the UK versus what happened in Europe. We actually touched on this, I think, a little bit in some of the webinars last year around how we have sort of non-equivalence between the UK trading venues and the European counterparts. And what we have now is Swiss and UK are equivalent with each other, so you can trade across multilateral trading facilities between those venues, and Europe then also, European venues are also equivalent with each other. Now, what actually has happened since really MiFID II is we've had a whole suite of new mechanisms, new trading mechanisms, things like systematic internalizers starting to come up. And here's a nice little heat map of all the different venues. There's a lot in the bottom right-hand corner, which we've sort of covered up, but the different sort of trading venues where across a selection of venues in Europe. And what we can see is, first of all, this big block of SINT that trades on systematic internalizers, which came up really since the introduction of MiFID II. But the big thing for me is the numbers of different sort of small venues that we see with lots of different mechanisms. So we have periodic auctions, sort of originally introduced sort of 4 or 5 years ago now. That they're across different venues. There's a whole suite of sort of post-trade trading at last mechanisms, different block venues, conditional order types, and really there's been quite a lot of different mechanisms that we see, which make it quite a complex picture in terms of understanding what's going on and making sure that you've really spotted all the liquidity that you can see. The US, the story is slightly different, but similar at the same time. So you've got still a big block of what gets reported through FINRA. That's off-book trades, sort of dark pools, anything that gets reported through that. We've taken this data from the SIP and it gets reported as a standalone block there. But you also then have the dominance of sort of NASDAQ and NYSE with a series of lit venues that go on top of that. So you have sort of a lot more, like we said before, trading on lit compared to a lot of the European venues. But there's a real sort of a smaller number of lit venues that are really there's a little bit less fragmentation there. So in summary, the regulatory differences mean you don't necessarily have the same types of trading mechanisms across the two, but you do still have this contention between what's traded on and off exchange.
Yeah, fantastic, Elliot. And we've got a few really good questions coming through, which we'll address at the end. Thank you for those who have posed some questions so far. I wondered actually if we can delve a little bit deeper into the detail So last month, for example, our team produced a market insights piece that analysed how dynamic tick size changes affect limit order book liquidity. And for the benefit of our audience, I wonder if it's worth just expanding on this to highlight the behaviour and potential pitfalls from stocks changing tick sizes and how this compares to the US.
Sure. No, thanks, Neil. That's a really good question, and it's another really good point in terms of some of the differences in the US and Europe, and it's something I think we'll explore a little bit more as we go on. So we posted an article on our website before Christmas highlighting some of the challenges you get in dynamic tick size regimes. So in Europe, the tick sizes tend to be very much dynamic. So as you change prices, the tick size adjusts dynamically with sort of bands set by regulation. So what I'm going to do now is just share my screen and talk through an example that we picked out on one of our visual products, our data viz products, and sort of walk through what that means. So here we've taken an Italian stock. No particular reason we've taken that. You would see this sort of phenomena across different stocks, anything where there's this dynamic tick size regime. And what you see is a sudden surge in this graph over a couple of days. Now, what we're plotting here is the average liquidity at touch in notional, so in euros, over time. And you can see between sort of the first, second, third of February to the 5th, 6th, 7th, it goes from sort of 40,000 euros notional sitting there to around 80 to 90. So really is a different level of liquidity that is put there. And what that means is, some people, you might think that this is because there's more or less liquidity. Maybe there's a market event that's happened here. But actually, that's not the case. And what's really happened is it's to do with the nature of these dynamic tick sizes. So if we look at something else, say the spread, which we can pull out on this chart, and look at the data, you'll see that the spread doesn't actually change at all. So there's typically, you think more or less liquidity. If there's an event which is causing a lot of liquidity to go into the order book, you might see that impacted in the spread. The spread, which here is in terms of basis points, hasn't moved at all. So it's not changed at all. So we're not really quite sure at this point what's going on. So let's look at the average price, so the VWAP price of this stock over the same period. And what you can see is between the 4th and 5th, the price crosses this €2 mark. Now, what's happening there? That happens to be a tick size. So the price has changed, and what's happening is the tick size is then changing, which means that market participants are market makers are adjusting their positions, adjusting where they're sitting on the order book in order to account for this. So the key summary really is that you don't see this, you're seeing this effect because of how dynamic tick sizes work and run. And actually, if we were to look at the spread in ticks rather than in terms of some sort of relative sort of basis points or sort of relative spread, we see that there's a sudden drop off in the number of ticks where it's sitting, because suddenly tick sizes got larger, so participants are moving nearer to the touch because they want to keep the same sort of risk profile on, but there's the tick size bands are actually larger, so they're moving closer, and that's what's changing this liquidity that we see there. Now, we actually, in the article, we dived into some of the level 3 data and actually looked a little bit at the order book to see what was going on in this example, and you can clearly see the orders moving from sort of being slightly more sparse to more concentrated when this change actually goes through. And as I said before, these changes, we've picked an Italian stock. It's nothing special. You'll see this on any European stock when they cross these particular price levels. And we found other examples, and this was just a particularly nice clean one. But it's certainly something that we can explore in more detail, and we wrote about in this article.
Yeah, thanks, Elliot. I think that's a nice segue to compare the different tick size regimes between US and Europe. You mentioned at the start that the US has a static tick size regime in Europe, whereas US has a dynamic tick size policy. Yeah, I'm wondering if you pick out a couple of well-known US stocks, are you able to take perhaps a closer look at the effect of tick size constraints and the key differences and how that plays out in terms of order book liquidity profiles between the US and versus the regime that exists in Europe?
Sure. Yeah. No. So that's it's a great question and worth reminding people. So in the US, in contrast to Europe, there aren't dynamic tick sizes. Tick sizes are 1 cent. It doesn't matter if you're trading something that's $10 or $10,000. It's the same tick size. Historically, I believe there was a sort of a pilot period where they looked at dynamic tick sizes, but now I'm going at the moment certainly they're static, and that has a different set of nuances that we tend to see. So we've pulled out a few examples again on our dashboard that we can show you. So here is I've picked, and I'll explain why I've picked these particular stocks in a second, but we've picked sort of Apple, Tesla, Google, Amazon, Oracle, and Verizon as 6 stocks, and we've just got their average price over the last month or so here up on the screen. It's worth pointing out that on the BMLL products, we have like over 6 years now in the US and over 5 years in Europe of these analytics, as well as the underlying level 3 data. But we've just picked a short period now just to highlight some of the key effects. So the first thing to point out is, there's clearly very different share prices between these different tickers. Apple, Oracle, and Verizon, and the reason I picked them is they're what we typically call more tick constrained stocks. So that means that the tick size is the average tick size is much closer to 1 tick. So participants can't move any closer. The spread is as tight as it can go based on the tick size. In contrast, Tesla, Google, and Amazon, partly because of their much larger share price, they're not as tick constrained. So what that means is there are lots of price levels in between the different levels that we see. And this leads to some different effects, not only in terms of things like spread, but also in terms of actual numbers of orders sitting around the order book and different ways that participants might have to think about how they interact with that liquidity and how they actually trade. So if I pick then the spread in ticks, again, in this particular case, let's pull it out. So what we can see, time-weighted one. If I remove Google for a second, because I think that was a bit of an outlier from yesterday, what we can see is the tick sizes are very different across different venues. And it's worth pointing out here, we've not taken the NBBO for this. This is aggregated across all of the different exchanges. Within this tool, you can split out a view so you can see on a per individual listing area level or doing a weighted average across the different venues. Clearly, the NBBO is going to be tighter than what we're seeing here, but this still illustrates the point really well. So Amazon and Tesla, spread in ticks on an absolute time-weighted average basis, you're looking at large number of ticks in terms of the average spread because participants can move in and out relatively freely because the share price is so much larger than the tick size. It's almost like it's continuous. In contrast, Verizon, Apple, and Oracle, small numbers of ticks on average. And if you were to look at the NBBO, it would be much, much closer to 1 tick. Now, what that means is it's a different sort of regime and a different sort of behavior. So if we take the liquidity around BBO and maybe look at the number of levels and look at, how many orders are there in this case, on the ask side at the top of the book. And we've pulled that out and we've got this here in this right-hand plot. So what we're seeing here is the average number of levels of orders, at the touch across different stocks. And you can clearly see, Verizon on this point, at this particular day, it's got almost 6 orders sitting there at touch at any one point. So clearly that affects queue dynamics in terms of participants trying to get to the front of the queue to get filled. You might have to think a little bit more about aggressing through the order book, or you might have to think about putting different types of orders in. If you want more passive liquidity, there might be different mechanisms you actually want to use to get that fill. In contrast with Tesla, Google, and Amazon, it's basically one order. If you want to get to the front of the queue in a passive sense, you can just increment that tick by that price by one tick, and you're more likely to get there.
I'm wondering, Elliot, how does that picture change if you're to look further down the order book? So look a bit deeper into the order book to see how the picture changes when you look at X amount of basis points away from the ask.
It's a really good question, actually. I mean, let's have a look. So we have, as well as the sort of individual levels, we can actually do it and say how many orders are sitting within 10 basis points of the ask, and we will get the picture here. So in this bottom left-hand chart now, and what we see actually, what's quite interesting, if you compare the bottom right and the bottom left chart, which is showing the liquidity at the top level and in 10 basis points away, actually Verizon and Apple have flipped, which kind of makes sense, right? Apple is hugely liquid. So, what's happening is you're getting, even within 10 basis points, you're getting lots and lots of orders condensed very close to that spread, all sitting there, on one or two different price levels, ready to go. Now, as I said before, this is aggregated across all of the different venues. We've done a weighted average here. You could easily pull this out and look at what's going on say the primary markets for them, or take the MBBO to look at them. But I think it's giving a really good illustration of some of the differences you see between these very large stocks and these very small stocks that you have in the US. And really the key point is that in Europe, with a dynamic tick size regime, you don't necessarily see the same types of effects. But as we've just seen, you can have other effects that you get from having a dynamic regime, and certainly things that go on around that point.
Yeah, that's fantastic, Elliot. In the spirit of time, we're 20 odd minutes in, so we promised to take a look back at 2021. So it'd be great, Elliot, if you could just talk through some of the big stories of last year. As we know, in the first quarter, we saw a lot of talk on meme stocks. The crypto and digital asset story was also in the spotlight, and towards the end of last year, and certainly that's continued to play out this year, attention has focused very much on central bank policy and the inflation story. So I guess, would you be able to take one or two of the big stories and analyze what impact these had on volumes and market quality last year, and how that's beginning to play out this year?
Sure. No, it's a really good question. Actually, we had a bit of a look the other day when we were thinking about this webinar, and one of the things that when me and my team looked at it was thinking, well, it's hard to believe it was a year ago since GameStop, and it's always a bit of fun just to look at the sheer change in a matter of days that we saw in terms of insertion rates, cancellation rates. So this again is on our visual tool. I've taken GameStop and I've just taken the number of insert messages going onto the order book in over a 1 minute period throughout the day. So we can see this, we can pull this down via our API, but I just think it's just looking at the sheer explosion in 2 or 3 days of what's going on. So you're going from something that's hovering in total at sort of a few 100,000 messages to the spike by this is the Thursday when GameStop was really exploding, and it peaks out at 4.5 million insert messages coming off straight in what looks like straight after the morning session. And it's amazing to see how that goes. And then by the Friday, it's sort of things had calmed down a little bit, I think, from memory, and it was going back to that sort of new level. This is obviously one example, but clearly by looking at what's happening on a minute by minute basis, you can see exactly some of the phenomena. Even here, actually, it's quite interesting. You can see that classic sort of liquidity U-shape you see in terms of more activity around the start, around the end of the day. What's happening the day before? I believe that was when there was some information about Robinhood stopping to trade it, and a few other things that maybe slowed down some of the activity on GameStop at that point. But by having this historical data, you can start to dive into these different questions and start to see what was happening down over time. And clearly, retail is something that is still a big effect. It's becoming more and more of an effect. Here's one example, but I think by looking at for this next year and this year, we'll be able to sort of analyze, well, what's happened in these previous events and see maybe what's going forward, what this means from for these type of stocks and this type of phenomena.
Yeah, fantastic. And I wonder very quickly, I know we've had some internal discussion as well. What the other big story this year, in talking to our customers this year, is the is the tension in the Ukraine and what effect that's having on order book liquidity. I'm wondering if you were able just to expand on that briefly. It was something that sort of really hit the tape, the news flow in Q4 last year, and has continued into this year as well.
Yeah, no, definitely. So let's pull this up actually. So I'm going to go back to some of the daily metrics. I think it's always worth remembering that as powerful as looking at sort of the sort of historical and order book level data, sometimes looking at a VWAP, looking at a close price can actually tell as much as that story. So let's take something like Gazprom. We have some ADRs. We don't yet have Moscow in our environment. It's something we're looking to onboard this year, but we can look at the close price of Gazprom and see exactly what's going on, and you can really see year to date the impact that some of the sort of the Ukraine crisis has had on that ADR pretty quickly. Obviously, historically, in the last 2 or 3 months, there's been a lot, and certainly since last summer with gas prices and the pressures we've seen on that. What's interesting to compare this to is if we look at, say, an Exxon and see what's gone on there, and you can see in the same period that obviously there's a lot of talk of Russian sanctions, what that would mean for Russian gas, etc. Certainly, in the same time, the oil major, well, one of the big oil majors, has gone up sort of quite substantially as well. So we can start to see how this will play out. We can start to look at these different analytics, different metrics. Certainly, it's something that is worth exploring a little bit more with some of our tools to see if there's anything more that we can see within the data. And it will certainly be a big story that everyone will keep on track of.
Yeah, fantastic, Elliot. Thank you very much. We've had a ton of questions, and I know we promised half an hour, but I think it's probably worthwhile just delving into a few of the questions. Let's take it in order. One quick question. Elliot, you've demoed single stock and ETFs, but can users see an aggregated view for indices as well?
Yes, no. So yeah, it's worth pointing out we haven't actually pulled out any ETFs in this, but and I actually saw there was another question on ETFs as well. We have a whole suite of ETFs on the platform as well. We take ETFs across Europe and US venues. It's actually a really interesting point. I'll maybe talk about the ETFs first and then go to your final point. So one difference that you do see in Europe and US is how ETFs behave and are treated, and actually didn't cover it before, but one of the sort of range of things we have in Europe with the ETFs is a lot of them go RFQ. We're seeing a bit of a shift back towards on-exchange trading, but a lot of it historically was done on RFQ platforms, the like of Bloomberg and Tradeweb MTFs. But also there's a lot of fragmentation there. So an ETF will trade in multiple currencies, will trade on multiple primary listings, as well as going through these RFQ mechanisms, as well as being on sort of dark pools, multilateral trading facilities, and it makes it quite a complex thing to dig into. And that's where something like our data really does help. But it's something that is quite different compared to the US, where it tends to be treated much more like an actual equity, and you tend to get quite different behaviors there. But going back to your ETF point, we have ETFs that are queryable, searchable in exactly the same way in our data lab. You can also include and look at selections of stocks, load them to do per venue comparison. That's all available within the products that we have here.
Thanks, Elliot. Great question from another member of our audience. You've talked a lot about the metrics this afternoon. Can you please articulate what metrics are level 1 and level 2 focused, and those that are level 3 focused?
Sure. Yeah, no. So level 3 for us is anything which worth defining. Level 3, I think different people have different conventions for that. So by level 3, we mean a per order level view of the market. So we have every single order ID, we'll follow that through, work out what's going on. So an example of a level 3 metric for us would be the actual average number of orders sitting at touch. So there we're seeing every order ID and saying how many different orders are actually sitting there. We're calculating the average number, we're posting that through. In contrast, level 1 metric would be something like a spread or a VRAP. Now, obviously, with level 1, which we consider the top of the order book, you can obviously get that from the level 3 data, but we also have the ability to drill down to get these more high level order book level metrics.
Great, thank you. And another interesting question, with the recent spike in volatility and volumes, returning to the story you were telling on the US stocks, are you able to show what trends we've seen in terms of spreads widening or contracting, and some insight in terms of order book behavior?
Yeah, sure. So that's a good question, Neil. So I think it's worth pointing out that we do have things like volatility and other measures there. So we can look at a whole range of metrics there. So a good example would be taking something liquid like SPY, obviously a very liquid ETF. We can look at how the volatility has changed and behaved. We'll get that up, pull and see where the volatility is going. You can see actually pretty clearly if I aggregate this across all of the tickers. So looking at a volume weighted view across the different markets, we can see for Spider in the last week or so, it's gone from, volatility has gone from, something pretty small, 0.1 to, it's almost a 4-time increase in volatility since the start of the year. So clearly some of the market volatility is quick and easy to see on this. It'd be really interesting, I think, if we had a bit more time, go back and see some of that Gazprom story in a little bit more and see, okay, can we see the volatility there as well? Yeah,
absolutely. Another question, returning to our slides at the start of the webinar, Elliot, the abbreviations you used on the liquidity map, wondering on the slide 4, I think it's the European liquidity map, could you just provide a bit more color on what the abbreviations mean?
Yeah, sure. Let me get that back up just to give context to everyone. So these are different MIC codes, market identifier codes, that we use to identify the different markets where there is trading liquidity. So X often corresponds to off-book trading. That's typically how it gets reported in European trade facilities. XLON is the London Stock Exchange. BATF is the CBOE off-book trading mechanism. XETR, Zitra, and we'll provide some of these slides afterwards, and we can more than happy, if anyone wants to understand any particular venue, we can provide that, and it's an ISO standard terminology for these venues that we use.
Fantastic. And wonder if you're able to comment on firstly the use of conditional orders in the EU and US, and 2, the dynamics of the trade at last liquidity over recent years. Is that something that we were able to take a look at?
Yeah, no. So it's a really, really good question. So that's something we sort of talked about briefly, but in terms of the different mechanisms. But yeah, 2 major mechanisms in Europe now are conditional orders. So mechanisms such as Turquoise Plato. I know SIX has just introduced a conditional order type on their mid-price dark pool, and it's something that seems to be growing in popularity. We haven't done too much analysis on it for this event, but you can see TRQM and TQEM, which are turquoise dark books. That will have a significant portion of notional traded, which goes through these conditional venues, and clearly it's something that continues to be popular. Likewise, the trade at last mechanisms. So for those who don't know, a trade at last mechanism, it's something that isn't on the primary venue, but allows trading to carry on fixed at the reference price that was from the auction. And we see it in Europe with Aquis trade at last, Turquoise trade at last, 3BOE, 3C. So there's a series of these trade at last venues that allow liquidity to come in to look at the order book. This chart, by the way, was pulled from one of our data feed products. It's called our granular trades classification, which provides daily aggregates of the data. And actually, one of the things that we have in that is we split out trading at last menus mechanisms. We split out conditional mechanisms, all making it easy to query that and aggregate up and slice the data in different ways. And actually, it's available back to, depending on the venue, 2017. So you can really look at how these venues have risen and changed in the interactions over time.
Super. And I think there's one final question I'd just like to address from one of our attendees. A wider tick concentrates more liquidity. What happens to the sum of liquidity at the touch and the new tick when the tick widens?
Sorry, Neil, could you repeat that one?
Yeah, sure. This is around the dialogue you were presenting on the tick sizes. A wider tick concentrates more liquidity. What happens to the sum of liquidity at the touch and the new tick when the tick widens? Maybe this is a piece of analysis we can run.
Yeah, absolutely. So let me share back on the screen, and if we go back to some of these, we can look at. So we've not included, so liquidity at touch. So when the tick has widened, you'll kind of see the opposite effect, right? The tick got, so when the tick size here got wider, the liquidity at touch also increased because more liquidity piles in to be nearer. Because if you imagine before there were two tick sizes where participants could have sat in either one, now there's only one tick size. So the liquidity at touch is actually putting more liquidity at that point, but the point is it's further away. So if you were to look at something like the liquidity within 10 bips from notional in this example, what you would see is actually, sorry, wrong plot. Here's the liquidity within 10 basis points. You don't see any change. You know, the participants, from the market maker's perspective and from a participant who's sitting there providing liquidity, the risk profile hasn't changed. So they're not actually changing the amount of liquidity they're providing. The difference is where that liquidity is sitting, because the tick has got wider. So there's fewer levels, there's fewer slots, if you like, for them to insert their orders. So the actual liquidity profile from the point of passive liquidity hasn't changed. What's changed is the position where they're putting in their orders.
Brilliant, thank you. And one final, very quick, fun question: do we track crypto assets? I guess there's ETFs in there.
So yeah, so in terms of crypto, we don't have any direct crypto data, but what we do have are ETFs, which we could see in this. We could pull out some of the ETFs. We also have futures data in the form of ICE, CME, and Eurex, not on our visual product here, but within our data lab. There we have the various Bitcoin and other crypto futures that you could use to obviously compare to what's going on the underlying. It's also worth pointing out within our data lab that you can actually upload data yourself. And we have customers of ours who will upload their own data, their own cash data, to compare to the futures and ETFs.
Thanks, Elliot. I guess on behalf of BMLL, it looks like sadly we're out of time, and I'd just like to extend my apologies to all the questions that we've not managed to answer today, but also more importantly extend an enormous thank you to everyone for joining us here today, and likewise thanks to Elliot for his presentation and insights. We sincerely hope you found the session, the webinar, useful today. We will respond to any questions that haven't been answered. We'll respond to you directly. We'd also love to hear your views on any content or insights you'd like to see added at future events. So please do email us at info@bmlltech.com or contact myself directly. Yeah, we will notify you all when we announce further events, and look forward to seeing you hopefully in person very soon. In the meantime, stay safe and well, everyone, and look forward to seeing you all very soon.